Welcome to The Explainer. So glad you're here. We are tackling something today that, let's be honest, intimidates a lot of really brilliant people, but it totally shouldn't. Yep, the income statement. If you've ever sat in one of those all-hands meetings, staring at a massive well of numbers on a screen and feeling completely lost, you are absolutely in the right place. We're going to demystify this whole thing. It's essentially the ultimate tracker of a company's success. Whether you're in marketing, HR, or operations, getting a grip on this document is a huge level up for your business literacy. And hey, don't sweat the jargon, because we are translating all that dense accounting speak into everyday concepts that just click.
Okay, to start us off, I want to pose a little mystery. How exactly can a company proudly announce, hey, we made millions of dollars in profit this quarter, but when they check their actual bank account, there is literally zero cash? I mean, it sounds like a magic trick, right? Or maybe even accounting fraud, but it's neither. Actually, this happens all the time in the business world. Hooking into this exact mystery is our mission today, and we're going to solve it together using the basic principles of the income statement.
Section 1. The business report card. Grading your company's performance over time. So to understand where the income statement fits into the whole shebang, we kind of need to zoom out for just a second. There are three core financial statements that pretty much every major company uses. First, we've got the income statement, which tracks operational performance. Then there's the balance sheet. That one shows the overall financial position at a single point in time, almost like taking a photograph. And finally, the cash flow statement, which tracks the actual liquid cash moving around. Now, while all three of these work together to give you the full picture, the income statement, which you'll also hear called a profit and loss statement or P&L, is incredibly special. Investors literally stare at this thing for valuation purposes, trying to figure out what the business is truly worth based on its operations. Meanwhile, lenders, they're scrutinizing it for a totally different reason. They just want to make sure the firm generates enough performance to actually pay the interest and principal on its debt. Moving to Section 2, money in, money out, the core financial equation. Let's dive right into the fundamental math here. And to do it, just picture a bustling neighborhood coffee shop. We'll walk through this core equation chronologically. Step 1 is net revenue. This is the money flowing in from your daily grind, literally. It's the total cash from selling those lattes and pastries in the normal course of business, minus any refunds you had to hand out because someone spilled their drink. Just think of revenue as the company's paycheck. Step 2, expenses. These are the costs you incur to actually generate that revenue. In our coffee shop, we're talking about the cost of the roasted beans, the milk, those flavored syrups, wages for your baristas, rent, marketing flyers, plus your taxes and interest. Basically, it's all the bills. And finally, step 3 brings us to net income. You take your revenue, subtract your expenses, and boom, what you're left with is your net income, your profit or your loss. It's whatever goes into the company piggy bank at the end of the day. Section 3, the matching principle trick, the secret of accrual accounting. Now, this right here introduces the exact concept that solves our opening mystery about having sky-high profit but zero cash. At a technical level, the income statement measures financial performance using what's called the accrual basis of accounting. And this whole system is governed by something called the matching principle. Basically, this principle dictates that expenses absolutely must be recorded in the exact same period as the revenues they helped generate, completely regardless of when cash actually changes hands. It's a strict, hard and fast rule. See, it's not about tracking physical cash, it's about matching the economic effort to the economic reward. Let's translate this so it really sticks. Imagine you go to the supermarket and buy a week's worth of groceries, and you swipe your credit card. You take those groceries home and you eat them all week. You are consuming that value right now. So under the matching principle, your expense is recorded right now because you're literally eating the food today. But wait, you don't actually pay that credit card bill until next month, right? The cash doesn't leave your bank account for another 30 days. Well, companies do the exact same thing. They record the expense on the income statement when it matches the revenue it helped generate, not when the cash finally leaves the bank. And that is exactly why a company can report a massive net income on paper today, but still have zero actual cash in the checking account until the invoices get paid next month. Mystery solved. Section 4, organizing the expenses. Sorting by nature versus sorting by function. So think about it. A massive company has thousands, if not millions, of individual expenses. If they just listed them all out chronologically on the income statement, the document would be, a million pages long? Totally useless to anyone trying to read it. So accountants have to group these expenses together. And they generally do this in one of two ways, either by their nature or by their function. Let's look at the first method. Grouping by nature means you combine expenses by their inherent type. It asks the critical question, what is this cost? For example, Say a company has heavy machinery in their manufacturing plant that's depreciating in value, but they might also have a whole fleet of delivery trucks or office computers in the administration building that are also depreciating. If they're grouping by nature, they take all of that depreciation from everywhere in the company, sweep it all up, and lump it together into one single line item on the income statement called depreciation expense. Then there's the second method, grouping by function, which you might sometimes hear called the cost of sales method. This combines costs associated with a specific purpose. It asks the question, what was this cost used for? So instead of grouping all the depreciation together like before, they might take the raw materials, the factory workers' labor, and just the factory machinery's depreciation, and lump all of those things together under a functional category called cost of goods sold. Why? Because the overarching function of all those specific costs was manufacturing the product. Choosing between these two methods is honestly exactly like choosing how to organize your closet at home. You can group by nature, hanging all the blue shirts together, all the red shirts together, regardless of how thick they are. You're organizing by the inherent trait of the fabric. Or you can group by function, putting all your heavy winter coats and sweaters in one section, and all your summer tank tops and shorts in another. You're organizing by what the clothes are actually used for. Both are perfectly valid ways to organize your closet, and both are completely valid in accounting. You can think of a single functional category, like manufacturing costs or cost of goods sold, as a whole donut. The individual slices that make up that donut are the natural expenses. The raw materials, the labor, the depreciation, they all live within that larger overall function. Once you understand this interplay, you can pretty much see right through the dense formatting of any financial report. Section 5. The odd extras: gains, losses, and other people's money. Now, the absolutely crucial point here is that not all money moving around inside a company comes from ordinary everyday business activities, like selling coffee or making widgets. Imagine an executive sitting there saying, wait a minute, we sold that surplus manufacturing equipment? That's not our ordinary business, but hey, it's still an economic benefit. And you know what? They're exactly right. The income statement has to account for this stuff. If a firm sells off old surplus equipment they don't need anymore, well, that isn't regular revenue. It's an odd extra. It gets recorded as a gain or a loss. Specifically, the difference between the sales price they actually get and the book value of that equipment is what gets reported. It definitely impacts the bottom line, even if it's not their main hustle. Because of these odd extras, our simple coffee shop math from earlier gets just a little bit more robust for massive corporations, which leads us to the expanded net income equation. You start with revenues and you subtract your ordinary expenses. Simple enough. But then you have to add in any other income, subtract other expenses, factor in odd gains, like selling off that factory equipment we just talked about, and finally, subtract any unexpected losses. This whole calculation gives you the true comprehensive net income. It accounts for every single increase or decrease in economic benefit, even the stuff that happens way outside the normal everyday course of business. Okay, there's one final, slightly tricky concept you're going to see on an income statement. What if a company owns a subsidiary, but not 100% of it? This brings us to a term called non-controlling interest, which you'll sometimes hear called minority interest. Basically, if a parent firm has a controlling interest in a subsidiary, meaning, they call the shots, accounting rules generally require them to consolidate the financial statements. But because they don't own the whole thing outright, the parent has to report the pro rata share of the subsidiary's income that it actually does not own. Think of it like chipping in for a large pizza with a friend. Because you paid for most of it and you organized the order, you get to carry the whole box to the table. That is the parent company reporting absolutely all of the subsidiary's revenue and expenses on their own income statement. You are holding the whole pizza box. But you can't eat the whole thing yourself. You have to subtract your friend's slice, the minority owner share, to know what you actually get to keep and eat. The non-controlling interest is subtracted when arriving at net income, simply because the parent originally reported all of the subsidiary's revenue and expense. So let's bring this all back home to that beautiful bottom line, $10 million net income. Now, you know that seeing a massive number like this on the business report card is fantastic for operational performance. It shows the company is generating incredible economic value. But because of the matching principle and accrual accounting we talked about, you also know that this $10 million doesn't automatically mean there's $10 million of cash sitting in the bank today. You know that expenses were grouped either by their nature or function, and you know there might be odd gains, losses, or minority slices of pizzas baked right into this final number. So, I'll leave you with this final thought. How are you going to use this new translation skill at your next quarterly earnings call? You're no longer just staring at a wall of numbers, right? You understand the math, you know the matching trick, and you get the logic behind the layout. I challenge you, look at your own company's income statement this week and see if you can spot whether they group expenses by nature or by function. It's a real game changer. Thank you so much for joining me for this explainer today, and keep learning.